Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, March 9th, 2023. It is 2:22 p.m. Eastern Time as I'm doing the video. I figured there's enough time to get another one out. Just wanted to talk a little bit more about what's going on in the banking world today. This is XLF. Did make got a post out to you on that one. If you go into the post that I made, the previous post, it'll be the one before this one, give links to that. Somebody asked where it was a trade. Remember, most of the trade ideas, if you've been with the site for a long time, back in the day, years ago, I used to spend a tremendous amount of time putting together a lot of individual posts on individual trade ideas, be it in ETF stocks, and I've migrated towards doing more and more of that in videos. So takeaway is, I know sometimes my videos can get a little long-winded, they go for a while, but that's where the vast majority of trade ideas on the site are. And that one was, there's links to the video on February 10th. I stated that as one of my favorite shorts, and also followed up with a comment in the comment sections. That's the other thing. I encourage you to, if you're interested in a trade, whether it's this, the semi, someone made mention there, good point, on the semiconductors, where it was in here somewhere, and hey, a couple people didn't agree on that, and that's fine. I mean, that's what it's all about. This is not a follow me site. I show you what I see, what I like. I really like that one. Even in that same video right after XLF was covered here, I went on to say that the semis were also one of my favorites. And yeah, it was February 10th, and that's where they pretty much peaked so far. So I still like that. That's just me. But again, do what you trade what you're comfortable with. And there it was back there, and we're still there. And I think this one has a lot of juice. And again, it's conditional. My reply was, and I'm going a little off tangent. I'll get back onto the off on a tangent. I'll get back on topic here in a second. But if the market goes down, and I'm always looking, with the charts being bearish. I've gone over what the long-term charts say. I've also talked about how the markets are kind of grinding around lately. It may not be, the big drop right around the corner, but today's move in the banking sector could be. There's usually takes some type of catalyst to really get things going, whether it's to the upside or the downside. So we'll see what next week brings. I'm going to go over the financials real quick, but I just wanted to add to that and say that one of the comments under one of the posts I made today on the semiconductors was that if, and it's a big if, but if the indexes were to take out, we're just in spitting distance, pardon my French, from that 200-day moving average on the S&P 500 and the downtrend line. So, a lot can happen over the weekend. You've got things going on with the regional banks now, and then, that can obviously spill over into the broader, financial markets if there are any problems with the banks. We already know crypto's blown up, all over the place. And so, and we know that a lot of, and I've talked on this back at the time, a lot of, even the big banks, they had their hand way deep in the cookie jar. Everybody got greedy with the crypto thing, big, Wall Street included, and the big banks. So anywho, we'll watch that, and I just want to point out that if we're going to get another leg down in the broad markets, and like I said, it can come any day now, could come next week. This certainly could be the catalyst. We'll see. Maybe not. I think it's warrants going home a little more short than, at least for me, than I might normally have gone home this weekend. Added to the semis, like I told you, and some other things today. And that's it. So, and where I'm going, I'm sorry. The semis tend to, I always say the gold mining stocks are a lot like trading gold, but on steroids. If gold goes up X, they tend to go X plus something. Well, the semis are the same way. When the market goes up, the big trends, there are times the semis can go against the broad market, but when you have the big sell-offs, especially in the tech-heavy NASDAQ, when it's a risk-off market, when tech stocks are getting sold, especially the big trends in bear markets, semis tend to go down a lot more. I've gone over that many times. Here's the correction. These are just bull market corrections in recent years since this whole great secular, or this is really just even a secular bull market within a larger secular. But the corrections have been 28%, 27, 39. This last one off the top was 48%. That first leg down, I'll call it, in stocks. much more, way more than the S&P, and even quite a bit more than the Nasdaq 100. So there's my point. This is just a higher beta. If you benchmark it against the broad market, it has much higher beta. It means it goes up and down more. Well, up more in the bull trends and down more in the downtrends. So it's kind of, that goes back to that I'm either going to be right or wrong thing, and if I'm right, I want to get paid more. Why put my money in the S&P 500 and short a bunch of steady eddy utility stocks and dividend paying blue chips? So that's what it's about. And then on that, I'm going to go off on a completely another tangent, kind of related, because I just brought it up. Somebody asked today about GDX, why wasn't it doing better? And I replied to that. Gold is up 0.97%. GDX is up well, now 1%. Actually, GDX was a little lower before, but it doesn't matter. Keep in mind, I've said this many times, that yes, GDX usually goes up more in percentage terms when gold's rallying, and down more. But during very strong sell-offs, if we are to get the next, well, whenever it comes, there are times where, many times, I've seen gold catching that flight to safety bid. Sometimes it gets sold down with equities. A lot of the old historical disconnects, or I'm sorry, relationships, have kind of disconnected, and the Fed's had such a heavy hand in the markets in recent years that the old treasury bonds going up when stocks go down, that they broke a lot of things in the financial system. So I always say trade each security on its own technicals, not on historically what it did against other things, because that relationship's kind of, a lot of things have been on off. Now, where I'm going with this is that the gold mining stocks, GDF is a gold miners ETF. It doesn't hold any gold. It holds gold mining stocks. Stocks are stocks. And what happens is they tend, during the very powerful sell-offs, quite often, even when gold's catching a bid, gold could go up, and I've seen where GDX goes up less, or sometimes even goes down, because those stocks get sold indiscriminately. So just keep that in mind. So during those kind of periods, I might shift out, take some out of miners and move more into into gold. And even same thing with silver. Silver usually outperforms gold in a strong rally, but sometimes not in those kind of markets, because gold's always been kind of the king of risk on assets. So all right, keep that in mind. All right, back to the charts. Let's get into the financials. KRE financial, these are the regional banks, and that is my daily chart. Probably I'm going to take, well, I'll leave this line here. I haven't updated this in forever. These are old lines, old levels. You can see previous trades on here and everything. And this is where we're at right now. That was a support zone. It was a pretty good support zone. In fact, if I haven't updated this line since, you can see 2019, that's when that, or 2017 I created the line, and then I moved it or tweaked it or touched it on 2019. So it's been that long. That's where I'd put it now, and that's really good. That was good support. You can see we held it here. We had some positive divergence. That's why we rallied off it, and then boom, you hit it again there, rallied up, and I would put this line there. So you had this little box, if you will. I'm kind of doing this analysis live as I'm doing the video, updating my lines. Boom, that's a breakdown all day long, and that's the kind of breakdown that's not going to be a whipsaw. That's not a little is it down below there? No, that's an impulsive red candle, massive volume. I don't know if you can see my volume bar. It's tuned down. It comes up to here right now. There's my volume bar. I have my volume bars. Really, I like a clean chart. I don't like too much color and busyness popping, but massive volume in KRE. And then you can see, these are PNC. This is the largest in the sector, component market cap weighted, or by market cap. And TFC, you can see that one hasn't broken down, but PNC clearly broke down a comparable support level. MTB moving lower, FTB Fifth Third. I used to actually work for that one. I worked for this one here, Huntington. Fifth Third I used to when I was back in my old days as a broker. I worked in bank brokerage programs after Merrill Lynch, and quite a few of these regional banks, because one bought another, and we always play that merger acquisition game, but some of those are still, even this one, Regions. Wow. So anyways, that one broke down as well right there, breakdown candle at support now, but you can see it took out the trend line. This is pretty ugly. This is a breakdown. Those are sell signals. These are just breaking down today, and then some of them are really, I'm going to show you this one's at support, but there's SIVB. That's the one right now with concerns about liquidity issues and all that. Let me just sort by percentage terms, gains and losses. SIVB is down. This is down 55%. SI Silvergate plunging, headed down. Look at that. It was a $20 stock just a week or two ago, and it's trading at $3.73. PacWest Bank. So these are the things. Like, we're in a bear market, and we've been in a declining macro situation. The bulls have been holding on to one theory, and you got to give them credit. The consumer's been holding up, the job market's been holding up, but that came in a little softer today. Markets initially rallied. This is, I like to quote Seinfeld episodes. I was a big Seinfeld fan, and I know a lot of you were. And there was that the whole scene, or the episode with Jerry talking about Bizarro World, where it's something to do with Superman, where everything is upside down or backwards, and so today you had the spike much higher than expected unemployment claims. Yet the market initially rallied because they're thinking, oh great, now the Fed, Powell doesn't have to be as hawkish. Well, we've been in almost a no-win situation for a while. We know the market it's going to go this way. If the job market stays strong and the consumer stays strong, Fed's going to continue to raise rates, and which is going to eventually really hurt economic growth. The only thing that's going to cause Powell to cow down is the job market rolling over, and then what that does, well, consumer spending is over 2/3 of GDP, so that's not going to help the macro. It's, again, I don't know, maybe there's a somewhere in between scenario that somehow for as far as fundamental analysis, macro situation, economics, that's bullish. I just don't see it. We're coming in a hottest inflationary environment in almost half a century, and so this is it. I just wanted to point that out, guys. That these banks are getting hit hard. These regionals, they are important, but the big ones are the big banks, and you have and the financial companies as a whole. XLF. You have. Let me just change this around. Let me go back to capitalization. Let's look at the big names. Breakdown backtest. J.P. Morgan. Coming up on support, and good support. So the buyers will probably step in, but remember, we're also coming off a divergent high. In that video on the 10th, I clearly stated the financials is one of my favorite sectors on the short side, and that's certainly played out. Now we're coming up on big support. The way it works in any bull or bear market, buyers should be stepping in here, and probably will. I would imagine at least a reflexive bounce there, but the weekend's coming up, and if something happens and there's we start hearing there's now this other bank has issues, that's the problem with the financial system. Everything's so intertwined. One bank has money loaned out to others, and there's all kinds of intermediaries involved, and in other words, it could be a vicious cycle. So we'll watch it, and if that happens, that's what you can watch for in a bear market. And I've traded these. When you get that, finally, if we are going to get that next leg down, it's probably going to come, and then at that point you just smash through one support level after another. We're not there yet. We're still above the 200. Look, and here's, as a matter of fact, J.P. Morgan's just back testing its 200 simple or exponential. But this on this I put a higher weighting on price. That's a big level right there, 129. So anyways, look, a level to watch. I'm going to set an alert. Goes through next week, maybe we gap down. If they recover it, that's fine. It's hold support. But if you start to move under there, and especially on these big banks, J.P. Morgan, there's Bank of America coming up on support 29.37, good support, a support level which should not be taken out, at least not on a closing daily, especially a closing weekly basis. Then I turn my focus to the long-term charts, which I probably should have started with. I'm kind of firing through, talking fast on all this. This is XLF. Here's my long-term trend line. It's not a perfect fit, but this is the one I've had forever and a day. It comes in, the financial crisis was mostly about the banks. That was the big thing back in 2007 to the 2009 lows. The banks banking system collapsed, and it would have failed utterly and froze up. The government didn't step in, so that was the big reason we had one of the sectors that took it on the chin the most. So it was a little bit of an overshoot, but then when things kind of normalized, this is the trend line we had, and this is where we broke down in COVID. And I've nicknamed that what I call Ursa Interruptus, bear market that was interrupted or prevented by the Fed and Washington, not just the Fed, both fiscal and monetary stimulus. And it was a bear market by every metric, or at least it was just the fastest one in history. 36% drop in the S&P 500 that was over, in 6 weeks. It was kind of akin to the Black Monday crash in '87. It was kind of over. If you blinked, you missed it. Anywho, but I think it's still a trend line that, because I can see it has been respected as you fast forward here. We took it out again and back tested, and we're still below it. So that's worth noting. Big support right here in XLF, and a likely target, I think, in the coming weeks here. And then if that goes, that's bad, because these are your pre-COVID lows right here. I think in this bear market, ultimately it does go, but we'll see. We'll take it step by step. I just wanted to kind of, again, do this video to reiterate that right now things have changed a bit, and I think that whole, I talk about the real-time odds, just like betting the ponies. Go to the track and the odds are changing on the board up until betting closes. Well, the odds just ticked up a little bit for the bearish case. We're still above key support levels. There's XLF. My target I gave you on the 10th of February, just a month ago, was at 34.44, and we overshot that and hit the next target. I have not changed these. These are still the next support levels, i.e. price targets. And this doesn't look like the correction's over. We'll probably, I don't know whether the buyers step in or not. We'll see. But again, even with XLF at support, let's see a little more downside. Like I told you, that's why I wanted to go through these components. A little more downside on JP Morgan before it gets there. Quite a bit more on Bank of America, almost 4.5%. Wells Fargo at trendline support now, but if it breaks that, that's no good. But you do have a little price support there before that 37, 36 level. Morgan Stanley, divergent high, breakdown. I mean, these are just charts that are playing out. That was a clearly bearish setup there. There's your divergence right here. And I also highlighted, I guess at this time, that there was a bearish PPO crossover right there. So there was a lot of reason to be short. Now, here's the thing too. If the market's going higher, if it's going to hold the breakout above the 200s, this is where, and again, I'm doing my little quotations with my fingers right now, the buyers should, that's what's in quotations, the buyers should step in. If they don't, then that's kind of bear marketish stuff. We're going to probably go down all the way down here to that 83.76 level. Yeah, I see a little bit of support. I'll give you a first intermediate target right there, about $89. Schwab, boom, look at that. Took out this beautiful, there's the primary trend line right here off the lows, very well defined. I'm even going to 86, this other one here. I don't need that one anymore. This one was very well defined. That's a breakdown. That's an impulsive breakdown. Also at support. So there's the common theme. We've had additional sell signals or breakdowns, but we have quite a bit of these big financial companies at or very near support where the buyer should be stepping in. So you might kind of want to, especially I wouldn't be shorting right now XLF. If you didn't have it already short, I wouldn't be shorting KRE right now. You could get some strong short covering rallies. Who knows? The Fed already was, under pressure testifying the last couple of days. Powell, they certainly gave him an earful. And maybe the Fed will come in and shore up, whatever regional banks are in trouble right now. And then the markets would initially rally on that. But ultimately, it's not a good thing. And the Fed's, losing. They don't have many arrows left in their quiver at this point. I think there's a sort of a resistance forming against additional bailouts and handouts to everybody and every company since COVID. But just want to put that line there. Anyways, there's Schwab at support. Reactions, the odds for reaction are good, but again, if it takes that level out, next stop is going to be down here. I have it about 61.59. I'm just kind of going through these. Really, I haven't even gone through these before the video. I just doing this live right now. AXP, American Express. I'm just looking for anything that stands out. BlackRock, Citi, downtrend line, rolling over at support as well. Chubb Financial, Progressive's not gotten the memo yet. They will. MMC, USB. Okay, what I'm going to do, I'm going to wrap the video up in a second. I'm just going to show you the VIX, talk on that real quick, and I'm going to dig through here. I'm going to look for cracks and other, there's different subsectors in the financials. BXK, what's it? BXK, I think, is the banking, BKX. BKX is the banking sector. So remember, XLF is financial. It has all insurance and banks and other things, a big one. This is just the banking sector itself. The big banks and the regionals and everything else. But I'll take a look at that. Every other subsector. I mean, I'll look at everything. I look at bonds. I look at credit spreads. The differential between treasuries and junk bonds. I look for that to be widening. That's often a red flag. And so far, we haven't seen a lot there. But VIX, I've talked to you about quite a bit recently. And like I said, guys, it's the odds have ticked up today considerably. That next week could be that where the markets just crater if something big happens. And you know me, I don't sell fear mongering. I'm just telling you as I see it. The odds are there. Then again, where it's support, maybe they step in and rally it. But I think to me, it's worth increasing overall short exposure. Like I said, not objective to add if you weren't already short the financials or anything. But I pointed out clearly, I think it was objective to add to the semis today. And whether you use SOXX or one of the leveraged ones, that's so far today since the highs. They've faded that rally to the tune of almost 3%. And keep in mind, the leverage ETFs work great in a unidirectional trend like SOXS, the bearish one I mentioned. In if the semis and the market were to fall pretty consistently and hard in the coming weeks, this one would most likely do better than 300 times the index, or three times SOXX. But if it's a slow grind down, we go, if the semis drop a little, bounce off support, rally, consolidate, then that's where the leverage works against you. Again, I've explained how that works in the on the website. If you go here and go to resources, then go to where is it? FAQ, frequently asked questions, ETF related questions, and this one right here. Is there a disadvantage of holding a leveraged ETF or ETP, like exchange traded product, that will include an exchange traded note, for an extended period of time? And then I go on to explain the mathematics on how that works and how it can work for or against you depending on the market conditions. So I would encourage you to read that if you haven't already. All right, and then last but not least, I didn't plan to get to it. I just want to mention that crypto, these are going to roll soon. These are the March Ethereum futures, ETHUSDRR. That's a mouthful of a ticker, but that's the ticker for the Ethereum futures. Right there, you got pretty darn good support. We've already just took out this trend line, and so if that breaks, Ethereum's probably headed lower. BRR, your Bitcoin futures, let's see, that's the actual crypto itself, took out 21,475 support today. Boom, moved down. It's coming up on the next support, 20,063. Remember, with the banks problems in the banking world, financial world, it's not good for crypto. And here's BRR. Oh, that's not the continuous. Let me see if I have anything on the continuous. Sorry, guys. Let me try to update that. Yeah, this is it. So BRR, again, the continuous contract for Bitcoin futures. Those are your levels right there. You can see it's taken out support and been moving lower. And I think you can see some potential divergence. So they'll either step in next week and buy up the financials, or if those support levels don't hold, we're going lower, crypto should outperform to the downside. It's usually that simple. Okay, I'm going to wrap it up here, and like I said, I'll take a look and see if anything else stands out. I got a lot of big banks coming up on support, and it's really those big banks that's certainly worth keeping an eye on. The JP Morgans, the Bank Americas of the world. If you start seeing them break through those support levels they're coming up on, not good for the stock market. All right, guys, I'm going to wrap it up here, and this has been Randy Finney with Right Side of the Chart. Have a great day.